or there's a global financial shock rippling through our system, a higher level correction is very possible. My verdict is that Canada is not in a classic 2008 US crisis, not yet, and not likely at all. But welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. So we're going to get into a really serious question here today. Is Canadian real estate in a bubble? We're going to look at the facts, the information, and the real opinions, plus my opinion, obviously, to help you understand whether or not Canadian real estate is in a bubble in light of all of the political news going on in the world, whether it relates to Trump down south of the border or the election north of the border. By the time you're listening to this, there most certainly will be a new prime minister or the same prime minister in Canada, but it doesn't matter because either way, case or scenario, there is a case to be said that Canada's real estate is in a bubble. But we'll play devil's advocate on both sides and actually represent this with data to help you make a decision as to whether or not we are going into some kind of a bubble or we are just going through a low dip. Let's get right into it. By the way, you're listening to the Flow Real Estate and Money Show, where we talk about real estate and money for Canadians that actually care to understand what's happening in the market with clear, specific information and my opinion where it makes sense. I'm Alex McFadyen, your host, and I own Flow Mortgage Co. mortgage company, helping out clients to create more wealth in real estate. But before we get into the evidence of this whole bubble or no bubble, I think it's really important to actually define specifically what is a housing bubble, because it's tossed all over Instagram, TikTok, YouTube on the daily. And of course, you get the trolls out there freaking out and posting that on every second video that I post, along with many others that say real estate is doing well. So let's talk about what actually a housing market bubble is. A bubble happens when home prices rise rapidly, fueled by speculation, easy credit, and not by true sustainable demand. Now, some people will say that we had a housing bubble in 22, 21. To a degree, yes, you could argue that is the point, that is the case. And in some situations, you could argue that's the case with, let's say, pre-sale condos. But traditionally speaking, it's not necessarily a housing bubble now, even though it may have been for some period of time. It didn't take very long. Eventually, the idea of a housing bubble is that reality catches up, prices flatten, then a crash, often wiping out all the equity and destabilizing the economy. So you want to think about the US in 2008, Japan in the 1990s. Those are classic examples. And so the big question is, Canada following the exact same path? Are we going into a bubble and a crash from 2022 all the way down into 2025? And are we going to see things just get worse looking forward? Let's look at the two sides here before we make a decision as to which one is the one that makes the most sense. So first of all, is Canada in a bubble? Okay, this is the case for Canada being in a bubble. The price to income ratios are through the roof. So this is basically affordability. Canadians are trying to borrow more money than they ever have been. And the affordability, even though it's getting better than it was a couple of years ago, like in 2023, when rates were all in 6.5% range, the affordability ratio is nuts. Like for Toronto, it's 11.5x median income, which means you need 11.5 times the median income to be able to purchase a piece of real estate. In Vancouver, it's 13.2x Canadian real estate. Now, in affordable markets, you might still consider like a Saskatchewan or small towns in other areas of Canada as affordable markets. The idea is that the markets typically sit at historically 3 to 4 times their median income. Now, we know that that's not really a reality in most places of North America anywhere anymore, but it certainly is more so than those major cities or those cities outside the bubble. Hard to say. The second fact, Canada's debt to GDP ratio currently sits at 109%, which is the highest in the G7. That's from RBC's April 2025 financial stability report. That's not good. And knowing that the cost of goods are going up and Canadians are more scared now than ever for things like tariffs and other potential expenses jacking up prices, we're in a position right now where we could see those debt numbers continue to climb sky high, and particularly in spite of all these mortgage renewals that are coming up in 25 and 26. 26 about to break records. The rising use of 35 plus year mortgage terms. Now, This is actually an interesting point because 35 years is not something that you commonly see in Canadian mortgages. In fact, that CMHC does not allow this, conventional banking does not allow this, OSFI does not allow this. But what you're talking about here is people who took variable rate mortgages where the payments were fixed and their interest increased to the point where they were paying down zero mortgage principal and they were paying only interest and in fact going into reverse amortization, therefore not even being close to paying off their mortgages on time. In these particular circumstances, we saw a significant amount of people accumulate more debt and in some situations accumulate more debt than their property values were, but we're not going to find out the real repercussions of this until 25 or 26 is over because of all the upcoming renewals. In 2021, the figure itself was only 5% of potential borrowers. As of right now, they're suggesting it's 18% of potential borrowers. And this is a source of Financial Post posted in April 2025. Number 4, the mortgage stress is growing on the economy. I mentioned this previously, but a recent stat from CMHC posted that 32% of home buyers spend over 45% of their gross income on housing right now, which is the highest it's ever been. And CMHC's affordability index posted that out. Now, that actually coincides with something that we're going to talk about in one of our future YouTube videos, which is why the new first-time buyer is 40 years old and how to get into real estate sooner, because it doesn't really have to be that way. But that's a little bit of a heads up on that. And if you haven't already checked out, I've got a YouTube channel. If you're listening on the podcast, check it out, Flow Mortgage Co., where we go into deep topics, but we actually specify and educate you on how to actually use those specific topics or terms that we talk about here. Number 5, unsold pre-construction inventory is surging. We know about the downtown Toronto condo projects, and we know about what's happening also in Vancouver. Well, in Toronto, we've seen a 23% rise in unsold units year over year. That is a high number. And let's be honest, most of those units are still sitting there because they're overpriced. And there is the competition to the point that it doesn't make any sense for them to underprice them because they're going to sell them at a loss, and they don't want to sell them yet at a loss. Number 6, investor purchases have cooled down. Although I'm going to asterisk this right now and say that in the last couple of weeks, I guess, I've seen a significant uptick in investor inquiries and in particular some closings that we've had recently. So although we have seen it cooling down, I've seen an increase over where it was last year and particularly in the start of this year. Now, that's typically a red flag, and the market suggests that non-owner occupied purchases fell 17% year over year. This could be short-lived, and we could see people jumping back in there if, of course, they believe that this is just the turnaround of this cycle right now. In past cycles, typically speaking, investors pulling back often preceded corrections in the marketplace. So we'll see if that actually is the case again this time right now. Number 7, interest rate sensitivity. And this is actually something that I see day to day right now. Over 800,000 Canadians are up for renewal in 2025, as we've talked about previously. And most of them are going to renew at rates 2 to 2.5% higher than where they were before. Now, although they're not seeing a significant increase in their monthly payments like they would have if the rates were 6.5%, they are still seeing a big increase. And those increases are having a negative effect on many of the different homeowners as far as their ability to make those payments. And that could mean more downward pressure on the real estate market if that continues to be an issue. We're also seeing an increased sensitivity around what the rates are, with people not making decisions based on strategy, just based on interest rate, which could actually have a negative effect in many other ways in the next 2 to 3 years. Number 8, stretch valuations across the secondary market. Smaller markets like Halifax, Moncton, and Kelowna, BC are showing price to income ratios over 7.5x, which is double their historic norms. So we could see a price correction in some of those communities, although they still seem to be holding relatively strong. It's hard to say if that's going to catch up. Number 9, we talked about obviously Canada's housing affordability, but it is actually the worst in the G7. More great news economically speaking for us. Last but not least, a significant economist warning here. Robert Kabjic, a senior economist of BMO Capital Markets, said this is not a supply and demand imbalance anymore. There's a definite froth built into Canadian market housing. Now, it's not unusual to hear economists come out and talk that the real estate market is looking like it's not looking sexy or it's not looking good right now. But the reality is if this sounds alarming, it's because it kind of is. But that's only one side of the story. And so I do believe that although there are a lot of signs for Canadian real estate to be in a bubble, there are just as many signs that are pulling back the other way. And I want to represent the other side of this actual argument. Now, before I get into this, I want you to listen to this entire conversation before you make a comment on the YouTube channel, or if you're listening on the podcast, you send me a DM at the Mortgage Pug or at Flow Mortgage Co on Instagram, because this information is so valuable when you consider the other side of the equation. And in particular, when we consider the fact that there is this election that's coming up and that's going to be closed by the time you're listening to this, something that happens there could impact these numbers. Now, with that all being said, my last note on this consideration is to keep in mind that almost anything significant could happen and change all these numbers in this situation. All right, let's talk about the reasons that Canada's not in a housing bubble. We'll try to bang this out in 5 minutes so that you guys can make a quick decision on what your thoughts are here with it represented based on demand. There's over 505,000 new permanent residents arriving in 2025 alone. I know they've talked about us reducing the amount of permanent residents in our country, but based on the applications and calls that I receive and what I'm hearing, although the demand is down, it's not down to a point where there's not permanent residents coming in the country. And with 500,000 people coming to our country, they're still going to need a place to live. And there's not that many people leaving the country relative to that. Number two, all those people suggesting that mortgages are going to default. The default numbers are still very, 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 very low. And this is actually more indicative of the market. Lending is safer than ever before. With high ratio mortgages, less than 20% down, they fell 18%. They fell down from 18% in 2020 to 9% today, which means that there's more people putting down 20% or more than ever before in homes. And I think that could have a lot to do with boomers passing their money down or some other transition of wealth. But at the end of the day, there's less people buying properties with less than 20% down. And so they've got more equity day one in the marketplace. Number three, the housing supply is still at a crisis point. And with, the liberals suggesting they're basically going to build a whole bunch of manufactured homes and the conservatives, they're going to loosen up the markets. There's no real quick answer to how they're going to build more real estate in a relatively short period of time. And so we still have supply crisis. I will state that the supply crisis is for specific property types. We don't need any more high-rise single bed or studio condos. We need homes that can house families, and that is the primary issue here. And unless they have a real plan, we're stuck without being able to fix this for quite some time. Supply is just simply not keeping up with population growth at all. Number four, fixed rate mortgages are insulating borrowers. 90% of Canadians have fixed rate mortgages, and mostly they locked in until 26 and 2027. So if there was going to be any type of a crash or bubble burst, it probably wouldn't be 2025. It would likely have to be 26 and 27. And by then, we could see a slight rebound in the marketplace. Number five, the stress testing. The stress testing actually has worked. We had a stress test that was a minimum 5 or 5.5% or 5.25% for the last number of years, particularly in 21 and 2020 and 2022. And because of that, when people are getting mortgages today at 4 or 4.5% or even 5%, it's completely sheltered them from not being able to make these payments. Like, they've proven that they can make these payments, notwithstanding the fact that a lot of these people have gotten raises in that period of time. And yes, I understand the cost of living has increased, but for this reason, there is a lot of reason to believe that Canadians can still make these payments. Number six, the bank health is strong. Canada ranks third globally for banking system stability. The banks aren't going anywhere, and we don't have any reason to believe that they will. Heck, they're profiting billions and billions and billions of dollars off us Canadians. Ain't nothing changing that. Number seven, prices seem to have already moderated, although national prices are down 2.9% year over year. That would definitely not be constituting any type of crash, more of a cooling. And the type of market, when you factor that in, is even more important because there's areas in Canada that are seeing increases, particularly single family homes that are not luxury homes in a lot of different markets, and townhomes for that matter. Number eight, construction bottlenecks are real. We talked about kicking cheap labor out of the country. Well, that's going to reduce the amount of people that can build our homes and cause consistent issues with that being the case. We're also seeing boomers retire in droves, and those are the guys who build the homes. So we need them on the tools, and this is just making it more expensive and harder to build, particularly the types of buildings that we're looking for. It's just physically impossible to build enough housing fast enough, especially in major metro areas. Number nine, the economic growth forecast remains very solid, which means that RBC's GDP growth of 1.8% for 2025 is moderate but not recessionary. This could change very quickly, but right now, there's a lot of reason to believe that we're not entering a major recession, which means we're probably not headed for any type of major housing bubble at this point right now. Lastly, there is the flip side in the economist argument, because I found another economist from TD's chief economist, Craig Alexander, says, yes, homes are expensive, but the dynamics today are driven by demographic and supply forces, not rampant speculation. So he basically argues that house prices are high. Yes, they're high, but it's not because of some kind of speculation, and they're not going to crash anytime soon. So while the market feels overheated, and there are solid arguments right now on the supply side and the rate side and on a whole bunch of different areas, things might not implode. They might just soften for the next couple of weeks until the point that they actually pick back up. Now, I want to quote a couple more economists before I get into where I think things could tip the scale one way or the other. I did mention the BMO Capital Markets. RBC Economics says moderation is underway. The sharp price escalations 2020 to 2022 are just simply not going to be repeated. A CIBC report in April of 2025 said Vancouver, Toronto will see mild corrections, maybe up to 5%, but crash risks are exceptionally low unless we see a global recession. My thoughts on the matter, I mean, of course, the wild card here would be immigration, both from a building perspective and from a purchasing perspective. But if immigration levels stay strong and rates stay relatively close to where they are, even if the BOC doesn't keep cutting rates, if fixed rates remain in the 4% range and supply continues to ramp up, I think we could avoid any kind of significant crash. I mean, again, we do have the wild cards of those condo buildings that were overbuilt, but the supply there's a lot of reason to believe that that supply is going to eventually get eaten up. And when that happens, there's no one building these buildings. So that'll just bring us right back up again. But the flip side to that is, of course, if unemployment rises, if the mortgage renewals have a greater impact on the marketplace and it squeezes households more than expected, or there's a global financial shock rippling through our system, a higher level correction is very possible. My verdict is that Canada is not in a classic 2008 US crisis. It is not yet, and not likely at all. But it's like walking an extremely fine line between price stabilization and potential correction in these overheated pockets. I think what we're more likely seeing at this point right now is pockets of the marketplace that are going to continue to be pressured and heated on. And the new government, whichever government this comes in place that is going to push forward, is going to have a ton of pressure to not only stabilize the building in the marketplace, but also stabilize price points. Remember, a lot of these boomers and retirees, they don't want to see the equity in their homes disappear anytime soon. And for that reason, I think the government will basically almost force the market to stabilize, and then it'll eventually come back up and continue to grow, as they don't really have any real solutions, let's be honest, either way. So, hey, thanks for listening to the Flow Mortgage Co. And if you found this information helpful, subscribe, leave a review, and stay tuned for more specific information. And if you found this one helpful, please let me know in the comments below or send me a DM so that I can understand what type of information is helpful for you guys. We're going to be experimenting with different types of content in the coming weeks, so I'd love to hear from you, and I can't wait to see you on the other side. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.